All right, welcome to Talk Tickers. Today, we're jumping right into Pure Storage's fiscal Q3 2026 earnings. The report dropped on December 2nd, and wow, did it send some confusing signals to the market. Let's break it down.
So, here's the big question, the real head-scratcher. On paper, this looked great. They beat on revenue. They raised their guidance for the full year. So you'd expect a pop, right? Instead, the stock immediately tanked, dropping between 9 and 11% in after-hours trading before it started to recover. So, what on earth spooked investors?
To figure that out, we've got to really unpack these results. This was not a simple, clean quarter. Honestly, it was like a tale of two different companies reporting at the same time.
And you can see that conflict right here. I mean, the contrast is just stark. The bull case is awesome. Top-line revenue beat, record non-GAAP operating profit, and they guided up. Can't argue with that. But then you look at the bear case, and it's just as strong. GAAP earnings, a big miss. Operating cash flow, it literally got cut in half. And even the adjusted non-GAAP EPS was just okay, nothing special. This right here, this is why the market went nuts.
But let's zoom in on that revenue for a second. Total growth actually accelerated to 16% year over year, which shows there's some serious muscle in their core business. And it was really their product revenue leading the way, up a huge 18%. That's being driven by really strong demand from big enterprise clients and, crucially, their hyperscaler customers.
And if you look forward, the pipeline looks just as good, if not better. Subscription annual recurring revenue, their ARR, grew a healthy 17%. But check this out. Remaining performance obligations, or RPO, which is basically all the money they've already booked for the future, that shot up 24%. So the backlog is getting bigger, which tells you demand isn't slowing down.
Okay, but the numbers are just one piece of the puzzle. You have to listen to what management was saying on the call. They're trying to frame Pure Storage as way more than just a storage company. They're positioning themselves as a fundamental building block for the entire AI revolution.
This quote from the CEO, Charlie Giancarlo, really says it all. Their whole argument is that the old way of doing things, where all your data is trapped inside different apps, is basically obsolete. To make AI work, your data has to be fluid, accessible, and ready to go. And that's exactly what their enterprise data cloud platform is designed to do.
And look, this isn't just a bunch of talk. They are putting points on the board to back it up. They've already blown past their full-year shipment goals for hyperscalers. They're pushing into the public cloud with a new native service on Microsoft Azure. And of course, they keep refreshing their core products. Management is making it very clear. Their AI strategy is in full motion.
Now, let's talk about how all this translates into their forward guidance, because this, my friends, is where the plot really thickens.
At first glance, the guidance looks fantastic. I mean, they're guiding Q4 revenue to be over $1 billion, and they raised the full-year outlook for both revenue and operating income. You can't ask for a clearer signal of confidence that they're going to finish the year strong.
But, and this is the big but, here is the smoking gun. The CFO went out of his way to warn everyone that after this year, they're planning to ramp up spending in a major way to chase all this growth. That one comment is the reason the stock got hammered after hours. The market heard higher investment and immediately started worrying about what that means for future profits and margins.
So let's put it all together. You've got this incredible growth, a really compelling AI story, but at the same time, you've got these huge questions about the cost of that growth. So where do we land on this? What's the call?
Our rating is outperform. We think the market is getting way too hung up on short-term margin worries and is missing the bigger picture here, which is a powerful, long-term AI growth story that is clearly firing on all cylinders.
And here's why. First, we know exactly what to watch for next quarter. All eyes are going to be on their Q4 numbers, and more importantly, any commentary they give about margins in fiscal 27. Second, think about that stock price action. The sharp sell-off followed by a full recovery tells me that the smart money is already looking past this margin noise. We think any dips from here are a chance to buy. And third, yeah, the risks around margins are real, but we believe the incredible growth driven by AI demand is going to more than make up for it over the long haul. Okay, for our last segment, let's put on our hedge fund analyst hat and talk about how you might actually trade this.
So the idea is pretty straightforward. You want to own the stock to capture all that long-term upside from the AI story. But you have to protect yourself against that very real short-term risk, the risk that they give weak margin guidance for next year and the stock gets hit.
So you could hedge that long position by buying some cheap out-of-the-money puts right before the next earnings report. It's basically a way to stay in the game while buying some insurance against the biggest risk we can see.
So there you have it, Pure Storage's very complex quarter. It's a classic Wall Street battle between a fantastic long-term story and some very legitimate short-term fears. This is not financial advice.